The five biggest economies in Europe in terms of descending GDP are Germany, France, Italy, the UK and Spain. In 2011, these five economies accounted for over 70% of total EU GDP. It's a pretty sizable market to say the least, and the importance of its outlook for investor and consumer confidence should not be understated. Now, some are suggesting that Europe is about to head into a Japanese-style lost decade, but here at Euromonitor International, based on our analysis and data, we're not convinced this is the case. If we look at each country individually, we can see the trajectory of recovery emerging. As the largest economy in Europe, the importance of Germany as a linchpin of economic pragmatism cannot be underestimated. In Germany, we are starting to see signs of stress thanks to the Eurozone debt crisis. Mainly we're seeing slowing real GDP growth rates thanks to easing level of trade, an ageing labour force, the government's programme of fiscal consolidation, and weak private final consumption. We're expecting to see weak growth resume in Q3 2012 of 0.7%, with no growth in Q4, before positive growth will resume in 2013. France has had a difficult start to the year, having had its AAA rating downgraded by Standard & Poor's in January and its outlook downgraded to negative. France depends on bank loans for 2/3 of its financing, a far higher figure than in most market-based economies. Given its exposure to Greek debt, any withdrawal of credit will have significant consequences on economic prospects in France. France is also seeing rising unemployment, a pensions crisis, and a high public deficit level, which the government is aiming to reduce to 3.0% of GDP by 2013. The likelihood of the French government reducing its deficit in the next year are slim. Italy has the second highest level of public debt in the Eurozone, second only to Greece. The main difference between Italy and Greece is that if Italy were to require bailouts as Greece had, it would bankrupt the entire Eurozone area to finance it. As such, every effort is being made at the moment to pull the Italian economy back from the brink. It's the only one of the big five economies that doesn't have a democratically elected government in place. Following former Prime Minister Silvio Berlusconi's resignation at the end of 2011, Mario Monti, an economist by trade, took up the post. The new government has reformed the pension system and pushed through €20 billion worth of tax hikes and spending cuts. The final quarter of 2011 saw the UK economy shrink more than expected due to exposure to the Eurozone debt crisis. As we move into the second half of the year, falling commodity prices and lowering inflation should reduce pressure on real incomes. In the UK, we are experiencing somewhat of a jobless recovery, as employment rates take longer to recover than output. Going forward, here at Euromonitor International, we're expecting unemployment rates to decrease from 8.8% in 2013 to 5.9% by 2020. Spain is in the midst of a major credit crunch thanks to the Eurozone debt crisis and is said to be one of the greatest risks to stability in the Eurozone. It has an unemployment rate of 23.6% and a youth unemployment rate of 45.1%. The government has just announced cuts of €27 billion to reduce its budget deficit and to shore up finances to avoid default. The country is facing negative growth until at least 2013, before returning to modest positive growth of 0.9% in 2014. So the answer is no, we're not facing a Japanese-style lost decade in Europe. We will see a moderate return to growth in 2013 and 2014. While real output growth will remain static, it will also remain positive, so to call it a lost decade is being overly dramatic. Structurally, the damage may take longer to repair as high unemployment rates, high public deficit levels and high public debt levels will affect each economy in some way, shape or form. These countries are also facing deeper challenges of ageing populations and loss of competitiveness to emerging economies, which will still be problems they're facing once the sovereign debt crisis is over. It's important to keep in mind that Europe has some long-term strengths which should aid its recovery, such as a well-educated workforce, major consumer markets, and a high degree of openness to external trade.